Hey there, I'm glad you're joining me for another video. Whether you're a subscriber, regular viewer, or first-time looker on and you enjoy my content, please consider supporting me by subscribing and spreading the word. You might find my content a little bit different from other financial YouTubers, and I would like to keep it that way. Let's tune out the noise of the markets and learn about investing. And as always, you can drop me questions in the comment sections, and timestamps will be in the video description. Investing is not about making all the right calls or catching moonshots, but rather avoiding fundamental mistakes. And if you avoid the 3 mistakes I'll go over in this video, you won't have to chase trends or hit any home runs in order to see phenomenal returns. Good investing is unfortunately quite boring and slow moving, and most investors fail to achieve even market average returns due to impatience, overconfidence, or irrational fears. So turn off your brain and avoid these 3 mistakes and you should be good. This one is self-explanatory, but I still want to put its impact in perspective. The most powerful thing in investing is time and accumulative growth, as this very simple example will show. So an average earner or young person might only be able to contribute $100 a month to, say, an index fund or ETF, which usually yields around 8% on an annual basis. Begin at an early age of, say, 20, and accumulation will do all the work for you, turning your monthly $100 into $688,000 by the time you retire. So this is based on 8% annual return and a retirement age of 70. Waiting till you're 30, however, would cut that in half to $310,867, which is 55% less than if you started at 20, although we only cut the time horizon, so amount of years, by 20%. Now, by the time you hit 70, you will only have contributed $84,000. Yet the average annual appreciation at 70 will add $55,800 to your portfolio, which represents a 33.7% return each year compared to your total contribution. If you want to catch up with the 20-year-old when you hit 30, you'll have to invest $220 a month. By 40, you have to invest $500. And by 50, you're going to have to cash up $1,250 a month if you want to retire with $688,000. To put things in context, if we zoom out, we can see that $1,000 invested in an average S&P 500 index fund in 1980 would have turned into $54,946 by 2020 without any additional contribution. So only $1,000, nothing more. That's a return of 5,494%, or 274% compounded compared to your $1,000. Some food for thought. Now, alright, it's captain obvious here. Now, most people, even those who invest, don't invest the majority of their savings. Whether it goes to spending, sits in the bank, or unnecessary high bills, the difference an extra $100 a month can do to your future wealth is truly mind-boggling. As shown in our previous example, $100 a month gets you to $688,000 from 20 to 70, given a time horizon of 50 years. $200, however, will double that to $1,377,048, which is enough to secure a comfortable living virtually anywhere in the world. Something even more powerful is early lump sum investing. So let's say you take $1,000 from your savings at 20 and invest it right away on top of your $100 monthly contributions. This is something most young people can do if they want to. Now that $1,000 will add another $46,000 by the time you retire, so 4,600% return. So that's actually what an iPhone today will cost you over the span of your working life. A PS5, that's another 23,000. Pair of AirPods, 6,900. The stock market goes up over time, and there's no point waiting around for the perfect timing or sitting in cash. Just invest right away and let time take care of the rest. If you want to learn more about lump sum versus timing the market or dollar cost averaging, check out my video on the topic. So if you have money sitting around or you spend it loosely, sit down for a moment and do some number crunching on how much your potentially bad habits or irrational fears might cost you further down the road. You know, there's a reason why they say cash is trash. You should have a very good reason for selling off investments, as the previous examples should have made clear by now. Money you invest should be money you don't need for the foreseeable future. Of course, emergencies can occur and life can throw you for a rodeo, and most likely will, but keep your money invested for as long as possible. Studies, statistics, and mathematics supports the theory that lazy investors do better than those who jump in and out of them. A long-term buy and hold investor is likely to beat 95%, if not more, of all investors, amateur or professional. I mean, the average investor only makes about 2.1% annually, and very few professional fare much better and even struggle keeping up with an average index fund like an S&P 500. Here's a chart showing how well lazy investors who picked up shares of some famous blue chip companies have done over the years. So this is if you invested $1,000 when the company went public, and how much you would have been left with in 2020. Now, these numbers might be difficult to even wrap your heads around, but remember this: if you invest $1,000 and it turns into $10,000 20 years later, each 1% gain will represent an additional 10% return on your initial amount. That's why it grows so fast. Now, if shares are sold with gains, you also might have to pay anywhere from 15 to 30% in capital gain tax, depending on which country you live in. This will result in an immediate loss, but the opportunity cost will increase exponentially over time, as the amounts lost to taxes could have grown over time. So here's an example. If you make 8% a year and you invest $1,000 over 20 years, here's the impact of what taking profits can have. So halfway through, in the second column, you sell a fourth of your holdings, and of that you pay 1/4 in taxes. So you pay $500 in taxes and you lose 25% of your holding. And at the end, the difference is going to be a 44% loss because you sold. So as you can see, the total amount of the investments goes down, and the opportunity cost of the tax increases. And you have to add those together to see what the sale actually cost you. Now, I'm not quite sure this example is a completely accurate one, but it roughly illustrates the cost of selling and paying capital gains tax. Now, this is all based on an index fund, which shouldn't be traded in the first place. And the same logics can't be applied to all investments. You know, investing in growth companies is truly an art, not a science. So be careful about applying rigid rules to investing. But for the long-term saving in funds or ETF, never selling is the most important factor for long-term success, and getting started early, of course. Now, I can go on all day, absolutely all day, maybe multiple ones, with math examples or arguments explaining why starting early with buy and hold investing is the holy grail of investing. All you need to know is that it is, truly. Forget fast money, high risk trade or speculative bets, just get invested and hold tight. And as a little bonus for those of you who made it through the video, Einstein once said that compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. So exponential growth is truly the most powerful force in the universe. So that's all I have for now. As always, I hope you learned something about investing today, and I hope to see you in my next video. As always, thanks for watching and take care.